Meanwhile, Wells Fargo joined other big U.S. banks in announcing a big second quarter profit, but a different story from Morgan Stanley. Michelle, let's start off with Wells Fargo.
Hi there, it's Linda. Well, Wells Fargo did announce a solid second quarter, but tempered that good news by reporting that it is still contending with losses from failed loans. Morgan Stanley on Wednesday night reported a third straight quarterly loss. Results were much worse than expected. Now, looking at the numbers, earnings after payment of preferred dividends were 57 cents per share, up from 53 cents a share, beating the estimate of analysts of 34 cents a share. Now, Wells was able to generate some record net income of $3.17 billion and a record revenue of $22.5 billion. But shares closed down at the close and are trading down in after hours. Investors concerned about the high jump in loans that aren't paying any interest at Wells. Non-performing assets jumped 45% this quarter at Wells Fargo. That is more than twice any other competitor. And Wells' non-performing assets now represent more than 2% of its loans, more than half of the increase in bad assets coming from Wachovia. Now, these were loans that weren't viewed as impaired when Wells bought Wachovia, so they hadn't been written down yet. Wells raising its reserve against bad loans by $700 million in the quarter, and some analysts are concerned that it's not enough.
They haven't still dealt with the issue that by the end of this year, they're going to have to take these conduits, or these loans that are off their balance sheet, onto their balance sheet, and they're going to have to come up with more capital to do that. So I think the outlook for Wells Fargo is not that attractive.
And remember, Linda, that Wells Fargo's big supporter is Warren Buffett. In fact, his company Berkshire Hathaway is the biggest shareholder. Still, Wells Fargo has been down 17% this year. Huss?
Hey, Michelle, what about Morgan Stanley?
Well, Morgan Stanley reported a third straight quarterly loss. Results much worse than expected. A loss of $1.37 per share versus the 57-cent loss that analysts were expecting. Morgan Stanley saddled with more red ink from the repayment of those government bailouts and the accounting ramifications of improvement in its debt prices. So, Huss, that controversial issue of mark-to-market accounting rearing its ugly head and taking a toll there. Now, the shares did close down today, but remember, year-to-date, the stock is up almost 72%. Huss?
Wow. Michelle McCory, thank you so much for that.